twice, 3 times, and all of that. All right, so I think we should get started, and we can repeat if there is, anyone will jump on. So what I wanted to really go over with you guys is there is really three things it will be taken for consideration as far as what would it take to buy a home and what's involved in it. One of the things I wanted to kind of share with you guys what is going on with the market. And as much as the news is trying to say there is, recession in home pricing, that's not what we're seeing on the street. House prices are staying steady. Interest rate, I honestly been in the business 32 years, and to see it in the 3%, the down payment assistance, you guys, the interest rate is 3.25. That is unheard of. To be able to buy a house with 2% and your interest rate is 3.25. So, I wanted to make sure that is information you guys have, and you're welcome to Google and verify all of that information, with, all of the economists and all of that, all of those websites. So with that says, because that's one of the things is on everybody's mind, is it really a good time to buy, or is it not? Is the prices gonna drop? And I really been seeing, myself seeing, and the client is also sharing with me, is there is homes, the prices are dropping on it. Well, if you really stop and look at it, the reason they are dropping the price because they started off with a higher price from get-go. So it wasn't priced correctly, and that's why the price, they had to adjust. Now, the homes, the one are priced well, believe it or not, there is still multiple offer on homes, and they are getting the price and over the asking price. I just had one, my client, they lost it. We offer $5,000 over the price, and still our offer did not get accepted. So it's, go ahead.
I was gonna say, I think one thing worth considering, at least what we see also happening in the market, is houses are staying available for about 15 days. So that's an average in Los Angeles, that a house is for sale and available and selling in 15 days, despite everything going on. So it really shows that even though COVID and people staying home, houses are still moving very quickly.
So, with that said, you guys, I wanted to tell you the 3 components of buying a home, and those components are equally important. And the first component is your credit. Credit is a huge factor, you guys. So I'm going to tell you the 3 components, and we'll go each one of them and what we need to do. So credit is 1. Your income, which is your employment and where is the income coming from, is 2. And then the third one is your down payment. So we'll start with the credit. Depending on the program, the one you guys are going to be getting, that will reflect what FICO score you are going to be needing for that program. So let's say, for example, we have a 600 FICO score, okay? Well, okay, so we need to work on that, because getting a 600 FICO score, there's not really much financing is going to be available for you. And if there is one is available for you, the interest rate would be very high, and the cost to get that interest rate would be very high. So the question is, what do we need to do to get that score high? You would need to look at the credit and find out what is the reason behind the FICO score being low. Could it be because we have a recent late? If you have a recent 30-day late, you guys, that will kill your credit 50 to 80 points overnight. So you can have a 700, you'll drop to 650 and it might be a 630, like that, okay? The second thing is it the reason our FICO score is low because what we owe versus what the limit we have? And that one is an easy fix. What you need to do is reduce what you owe. So pay down some of the bills to bring down your balance. You always want to, as much as you can, have your balance not to exceed 20 to 25% from the limit the creditor gave you. You can always call the creditor and have him increase your limit so you can get the gap, you know, a little bigger. And that one is by you kind of like maneuvering the system. And the reason you can, because if you guys know, the system is algorithm. It is not a human being. It is a computer brain. So if you tweak the number, then you'll get what you want. The other reason could it be is, do I not have enough credit? And if you don't have enough credit, the easiest, fastest way, if you would ask a family member, a friend, they trust you, is you would be added as an authorized user on their credit card. Now, people are so scared to add somebody to their credit card. And I totally understand that. It makes a lot of sense. Now, what you need to tell them is though, and please remember those words, because that's the only way they're going to be willing to agree and accept that, okay? So what you're going to be telling them is, when you get the credit card, first, they have to call the credit card to add your name on. The credit card have to take your social security number in order for that to show up on your credit, okay? Now, you're going to tell him, when the credit card comes in the mail, don't give it to me. Rev it up. I don't need it. Okay? Which you really don't, because the whole aspect of this is not for you to have a credit card to use. No, just for your credit score go up. What will happen is, once the next cycle of that statement comes up, all of a sudden you gained that person history. Meaning is, if you ask mom, for example, and mom had 20 years of that line of credit, then overnight you got 20 years of beautiful history mom have. Okay, so that's another way of getting the FICO score up. What I usually do though, you guys, with all my clients is we run the credit. Actually, the lender run the credit. I don't, because I'm not a lender. And I really don't get paid from lending. I just know so much about it because I know how important is it to be a first-time buyer. And I know how important is it to match whatever the payment you've been told and the total money out of pocket you've been told. So the lender run the credit. Once they run the credit, then they give us what steps we need to have you do in order for you to increase that FICO score. So that's what I usually do with my client. Now, when it goes back, let's say the credit is beautiful, then we go to the next step as far as your income, okay? On the income, you guys, there is two kind of income everybody gets. One is your W-2 employee. And when you're W-2 employee, then if you are not in any way, shape, has any business expenses, then whatever is on your W-2, that's what your income tax is showing, okay? Now, if you are a W-2 employee, but you do have business expenses, meaning is you take client for lunches, you buy stuff for your business, whatever it is, then the W-2 income, the tax man, in order for him to be able to get you the most return, which is the truth anyway, because it's a business expense, is he writes that as expenses. So yes, you can make on a W-2, $50,000, but then the income the lender can use is only 45 because there is $5,000 went for business expenses. Okay. We're not talking about a child care. We're not talking about your regular write-off, having a family member live with you or whatever it is. No, we're talking about business expenses, okay? The other kind of income people has is the one self-employed, which self-employed gets 1099. So what is a 1099 is you go do a job and the person pays you the whole amount. There is nothing going for Uncle Sam. The W-2, the one you got, some of that money went to Uncle Sam because that's why it's a W-2, okay? The 1099, nothing goes to IRS, and it's up to you as the employee to be able to report that to IRS. So what happened with the 1099, because of the fact there is nothing being given to IRS all year, then you accumulate all of those 1099 from different employer, and then at the end of the year, you have $100,000. Well, because you're self-employed, you do have the expenses of the business you are conducting. You do have your rent space, your equipment, whatever. So the taxman collect all of that, and then whatever is the leftover. So you can be making $100,000, but then the income you're able to use as qualifying income is only 20 because the rest of it went for business expenses, okay? So that is a 1099 employee. So what happened was that if we are using government programs, then they will take 2-year history and average it. So you got 2018 and you made net 50,000. You got 2019 and you net another 50. So your average is 50,000, okay? As far as a conventional program with a 5% down, you have a high FICO score, you might be able to get away with only 1 year self-employed, okay? Now, when it comes to the employment, you guys, the lender is looking for 2-year history on the job. It doesn't have to be the same job. You can be just starting a job and you've been in it for a couple of months, and then you had a prior job for another year, and you had another job for another 6 months, and so all they want is there is history of you've been working. Okay, I get to ask a lot because some of the clients, they say, Nahid, we have 2 jobs. Okay, so when you have 2 jobs, if you've been working both jobs for 2 years, then both jobs can be used. Okay, if you has one job, it's been 2 years, and the other one you just started 6 months ago, they will not be using it. And the reason it is because it's not a normal thing for a person to do a full-time and a part-time. So they want the 2 years to make sure you are able to handle 2 years of having 2 full-time jobs or a full-time and a part-time job, okay? What other thing? On the income. So let's say we didn't make enough money and we needed help, okay, as a co-signer. That co-signer, you guys, could be a family, could be a friend, could be a grandma, could be, could be a business associate, and you can be as a partnership. So the income comes out of that person will be added to your income, and then the debt of that person will be added to your debt. So let's say grandma is on Social Security, then grandma can help you co-sign. If she is on SSI, then she need to ask the SSI because I am not sure she'll be able to help you co-sign. If mom or dad is on permanent disability, they can help with permanent disability income. If they are on retirement, they can help with retirement income. So there is really, any variety, okay, let's say there's income coming in from a child because a child has a disability. That income will be used as added on. Let's say there is an income came out of a divorce and it's a court order and it's a child support. That income can be used as added to your income. Okay. One of the things I forgot as far as credit, you guys, was the bills, because that happens is when you co-sign for someone as you help them out to buy a car. And with the co-signer for buying a car, if you are a co-signer and that person make the payment and you can provide 12 months cancel checks as that came out of their account, then that car payment will not count a debt against you, okay? If it's coming out of your account, they're giving you the money, you're paying the bill, then no, that debt will be counted against you. And the reason I say we need to pay attention to the debt, because the way the lender looks at it, there is a debt to income ratio. So they look at your gross income and they look at what the bills we have, and there is a ratio. Some ratio will go all the way up to 55%. So your gross monthly, 55% out of it, that will equal your mortgage and the bills on the credit card. On the credit report, don't confuse the bills. They do not look at your cell phone bills. They do not look at your rent payment. They do not look at utility. They do not look at food. They leave the 45% for that. So the 55% will just cover your mortgage and whatever is on the credit report. So if you have a student loan, that is counted. If you have credit card, that is counted. And it goes by the minimum payment, you guys. It doesn't go by what you like to pay, just the minimum payment. If you have a timeshare, that is on the credit report, that is counted. So anything goes on the credit report, that would be what it would be counted as a debt against you, okay? So with that, now we go to the down payment. And the third component with the down payment, you guys, is basically which program will require what. So if you are blessed and you went to the service, then you have a DD-214, which is a VA loan, which is if you're still in the service, you don't have it, but it's okay. You can be able to buy a home with absolutely no money down. There is only closing costs. Now, with that in mind, some people say, but my dad has it. Can I use dad? Absolutely not. My sister has it. Can I use sister? Absolutely not. The only VA you can use is you, and you can only use your husband or your wife income together. So let's say your girlfriend, boyfriend, you cannot use both income and use VA, only the VA person, okay? The other program is available for you guys is FHA. FHA is a federal home loans, which is HUD homes, okay? On the FHA, they are made for you to be owner occupied. Some people confuse it as a first-time buyer. It's not really a first-time buyer because you can have an FHA and you bought it 10 years ago and you sold it and now you don't own a home, you can buy FHA again, okay? So with the FHA, the main core of the FHA is you are going to live in it as your primary resident. That's all it is as far as the FHA loan. So with the FHA loan, is your down payment is 3.5%, and then you have your closing costs. With the FHA, you guys, you can buy one house, you can buy a condo, you can buy a townhome, you can buy a duplex, you can buy a 3-unit, you can buy a 4-unit maximum, okay? Now, if you're buying your first home and you're going, well, you know what, Nahid, I'll buy a home and then after that I'll buy units with FHA. No, because they're not gonna believe you. You're moving from a single family resident to be a landlord, okay? So if you can get a duplex first and you live in it, and then a few years later, you keep it, you rent it out, and then you buy a single family, you'll be able to do that, okay? Now, with the FHA loan, you guys, your payment is a fixed rate. Taxes, insurance, everything included in the payment. There's a couple of things never included in your mortgage payment. Utility bills, never, ever, ever included. And your HOA, if you end up in a condo or a townhome, that's never, never, ever included in your monthly payment, okay? The third program you can go to is, the name of it is CALHFA, which is a down payment assistant. And how the down payment assistant work is, hey Daisy, you are going to be put in is 2%, and that's all you need, down payment, closing costs and everything, and they will loan you the money as a silent second. So your first loan will be an FHA, so it's combined with FHA, and then you have a silent second for that down payment assistant, and that down payment assistant, no payment required. You will have to pay it back when you sell the property, okay? Meaning is, when you sell it, you gotta pay it back. Meaning is, if you refinance it, you gotta pay it back. I get that question asked a lot. Well, Nahid, what if I never sell my house? I said, that's beautiful. At the end of 30 years, you still owe the money. So you're still gonna be paying the amount and the simple interest. So they don't charge you the compound interest, they charge you simple interest. So your first loan is FHA and your payment is based on the first loan. The silent second, there is no payment for it. You are welcome to make a payment if you want to, but they do require $100 minimum payment, okay? The last loan is available for you out there is a conventional loan, which is Fannie Mae, Freddie Mac guideline, which is a 5% down. Some, they have a 3% with criteria. And with that, you have to come in with your down payment and your closing costs, and the FICO score has a huge factor on that. So let me back up a little. On an FHA, you can get into a property with only 620 FICO score. You're not gonna get the best interest rate, but you can buy a home. On the CALHFA, your minimum FICO score is 660. So they will not take us if we are under a 660. On a conventional, you guys, it is a 700 FICO score. And the way the conventional interest rate work is, they have 3 tiers. Your FICO score from 700 to 719, you get 1 interest rate. 720 to 739, you get a better interest rate. 740 and over, you get the best interest rate. So if you have a 750 FICO score, or if you have an 800, you will get the same interest rate. But if you have a 739, you will not get the same interest rate. So usually what I do when I have that with my client is we look and find out what do we need to do to get the score that one, you know, or a 5 or whatever it is, the shortage for us to be able to get the best interest rate. So I'm trying to think if there was anything else as far as the different programs out there and what would it take. I think that kind of covers it. Chris, you have a question?
Yeah, what's your advice to people that are sort of contemplating between, like, should I wait a little bit longer, save more money to go conventional? Should I pull the trigger now and go FHA because I don't have to wait? What do you tell people?
Okay, so to really be honest with you guys, and that's one of the things I really do want. Whatever you hear, I wanted you to do your homework and check into it. What does that really mean? Because of the fact now with the technology and the social media and all of that, is really easy with push up upon, you know, a key, you figure out everything. So when you are buying a home, you're buying a home for a long-term investment, okay? The prices of the homes, you guys, no matter what you're gonna say, well, Nahid, in 2007, the market crashes and all of that. Well, you know what? Yes, it did crash. Now, can you give me one house? It was sold in 2007, 2008, and I can get it today for the same price? Absolutely not. Absolutely not. So when you say, I want to wait, I will respect that. But the question I got to ask you is, you want to save money. Beautiful. How much money are we saving? We're going to save $1,000 a month. We're going to save $2,000 a month. Let's say $2,000 a month. When you save $2,000 times 12 months is $24,000 you guys saving. What is the prices of the houses from? And you can do the math, you guys. I don't have to do the math for you. You can push a keystroke and you can find out what is the prices of the home was in 2019 January and January of 2020. I wanted you to do that math, for heaven's sake, because that math, and that is anything out there, and you can just put an address of a house is sold and you know is the prices from 219 to 220 is 4-5% from the price of the house, you guys. You do the math. If the house price is 500,000, what is a 5% off of a 500,000, you guys? So that is one factor. There is nothing you can do about that. Okay, that's one. The second factor I wanted you to look at, having an interest rate of 3.25, and that's another one you guys can, with a, you know, a key, you can figure out what was the interest rate in 2019, what was the interest rate in 2018, what is the interest rate in 2017, and if you look at the history, 4%, 4.5%, 4.7%, 5%, 5.5%. Now, I wait a year where I am going to be on the interest rate. You cannot control. There is two factors when we're buying a home, you guys. You cannot control the price. You cannot control the interest rate. Yes, you can control your saving. And the dilemma is we're not able to save enough to keep up just flat with the market, just flat with the interest rate. And when we're looking at a 1% interest different, Lord have mercy, huge of your monthly payment. And it's not just the huge of the monthly payment, you guys. Your qualification, it starts by how much your mortgage payment going to be, what your debts are, then you have a dollar amount I qualify for, okay? Now, say for example, $500,000, and this is just numbers. Say for $500,000 at a 3.25 interest rate, my payment, say $3,000, okay? Now, for the same 500, let's say the market is not gonna move, okay? Stays at 500, and then the interest rate went up to 4.5, that 3,000 is gonna be 3,500, 3,600. Then what happened is, you're not going to be able to qualify for 500 no more, because your qualification depend on your mortgage payment. Your mortgage payment depend on your interest rate. So the lower the rate is, the lower your mortgage payment, the higher you qualify for. Does that make sense to you guys?
Yes.
Okay. So, I hope that answered the question. Now, do you guys have any question? Any thoughts going through your mind? Okay, I forgot to say something. If you do have any anything as far as like bankruptcy, you guys. On an FHA, bankruptcy only need to be 2 years from the date of the discharge. On a conventional loan, need to be 4 years old from the date of the discharge. So, so that's how the law of the bankruptcy is. Chris, question. I cannot hear you.
What is your feeling right now with everything happened, COVID, to be shopping or to be in the market right now?
Okay, so look, you guys, when we started the COVID, I honestly, we all never been in a scenario like this. And even though I've been in the business 32 years, I had my fears. I was like, I wonder what's going to happen to the real estate. I wonder what's, you know, what are we going to do? Is people going to still shop? People going to still sell their homes? And the crazy is though, is busier than ever. And the reason it's busier than ever, I think it has a lot to do with the interest rate. I think, I will say maybe the first couple of weeks, people were like, on the fence, should I not? Now everybody's saying, this interest rate is not gonna last, and it just is not gonna be like this forever. One of the things, and that's my thoughts, and if you look at the history of our country, when it's election time, you guys, whoever the president is, if they're gonna try to be reelected or whatever, they really watch interest rate, because interest has to do with homes, and they want the economy to continue flourishing so they can have, you know, an upper hand on being reelected. And I see that year, you know, every 4 years, it just happened. And honestly, this is another one is going to happen. After the election, I really don't know where we're going to be as far as, you know, the prices, or as far as the interest rate, and do they need to keep it down? Do they not? I honestly don't know the answer to that. The one thing I do know though is the difference of what happened back in 07 and what's happening now. Back in 07, the lending institution had a lot to do with the real estate recession. And the reason of that, all of you guys probably were a bit young and you don't remember, but what happened back in 07, all of the lending institutions were given an interest loan only, which it was based on a 1% interest. So it was just a bogus interest rate. And they were counting on the market is going to increase, the interest rate is going to go up, and they were not qualifying people. They were just basing it on people's FICO score. So when the market crashed, the government did not step in, did not do anything, because it was felt it was government, the bank kind of created it. In this here, and all of us are living through this, you can see the government is doing everything they can, between the stimulus package, between the unemployment, to try to, telling the bank. Honestly, if you guys ever call a mortgage company now, the one where people make their payment to, 90% of them have an answer machine to say, if you are affected by COVID, go to that website and fill in the information so we can see if you can qualify to make an arrangement with you regarding your payment. So the banks are working with the people if they are having difficulty making a mortgage, so they don't foreclose, which of course, if there is no foreclosure, then there is no drop in prices, so that's what I see right now. It's totally different than what it was back in 07. So I don't know if any of you guys have any other question I can answer. I believe I covered everything as far as from the credit to the income to the down payment. If you guys want to, I can cover with you as far as the process. You know, as far as how does it go when, you know, if you like a house, how the offer, how the inspections is, because that's another thing you guys going to be doing once that, hey, Rosava, once the process is start. So, so for example, let's say we looked at houses and, hi, Rosava, and we like the house. And once you like a home and you are in the process of like, okay, I love it enough, I want that house. So when we make an offer, you guys, there is a few things in the offer as a contingency. One is contingent on us doing an inspection to make sure, hey, the house is what you see the outside, which you see the shell, but you really have not seen your foundation. You haven't seen the plumbing, you haven't seen the roof, you haven't seen the electric. So that is the reason we have the contingency of the inspection, which I highly recommend. Is one of the major things is to do an inspection to make sure the house is in you know, in a condition what we can, or if there is a major problem with it. The other contingency is the appraisal. Appraisal is a huge thing, you guys, because you have to remember, with the appraisal, the lender send an appraisal. That appraisal gets paid $500-600. He really cares less you buy the house or not. He has a license or she has a license, and they want to make sure they follow the guideline. So what the appraisal do is they look at the price of the house, they look at the condition of the house, they look at the square footage, they look at all of the houses around it, and they come up with a value, okay? And that's it. So if the appraisal came in to the same price what we agreed on, beautiful, you'll get the loan, everything goes great. If the appraisal came in higher, that's even better. So you got a property under market. If the appraisal came in lower, then we have to go back and negotiate with the seller, because we cannot get the loan because the lender loan based on the appraisal. The other thing we always have a contingency on is your final loan approval, which is a combination of the appraisal. Even though we're approved and all of that, they still have to go through the appraisal and put all of that package together. So when we make an offer, is yes, you want to be sincere, this is the house you want, because once the offer is accepted, then your deposit have to go to escrow, but then those is the contingencies. So a lot of people ask is like, what is really escrow, Nahid? What really goes in those 30 days? So in that 30 days that you guys would know, it goes from the process is the offer is accepted, you send in, you wire your initial deposit. The escrow company draw the escrow paper, which is the same as the offer. Then you sign them and you fill out a form. The name of it is SI, which is a statement of information. And the reason you fill out that form, because the title company want to make sure there is no liens, there is no judgment against you. It didn't show up on the credit with the lender, but it could show up on your title. Seller, by the way, fills out the same thing to make sure there is no judgment, there is no liens on the house, because that is what you are buying. At the same time, so escrow is doing that, you fill out that paper, we go do an inspection, make sure the property is what we, counted on. If there is any repairs needed to be done, then we get a list together, go back, negotiate with the seller. If the seller is willing to repair or give us a credit or, whatever the case might be. And then at the same time, the lender is sending the appraisal to make sure the value is there. They're sending verification to your job. They're sending verification to the bank for your bank statement to make sure the number is matching. Once the lender get all of those together, then they submit the file for a final loan approval. If you have an FHA, then it's only one underwriter, FHA. If we're doing a CALHFA, then the file gets approved from FHA, then it goes to another government agency to get approved. Once the final approval came in, then the lender send in, we call it disclosure CD, which it has your final, you know, total money, your monthly payment, and all of that. You get that in the email, you sign it, it is a time sensitive. Once that is signed, then your final loan document is ready. Those final loan document has to be signed in front of a notary because it has to be notarized. Once you sign those final loan document, then we wire the balance of the money. Once balance of the money is wired in, then the escrow company ask the lender to fund your loan. So if your price is 500,000 and you put down 10,000, then the lender is going to be given, 490,000 loan. So they ask for that fund. So they get the loan. Once the escrow company gets the wire, then they set up the file with the title company. The title company actually send it to the county record, which nowadays, thank God, is electronic. Back in the days, it was not. So if we would have ever had the COVID 10 years ago, housing would have been stopped if the county record closed. So so they send it to the county record record. Once the property record on your name, then at that moment you are the legal homeowner and the old owner is done. It's off his name. The seller gets his money. It takes about 24 to 48 hours from there for the escrow company to balance their files, send the checks to everybody. So that's really in a kind of like a quick nutshell, what's the escrow and who's the escrow and what goes in the escrow and all of that good stuff. All right. So I don't know if you guys have any question. I think I kind of give you every kind of a little bit of a overview of buying a home and being a first-time buyer. Oh, one of the things I totally forgot. On the CALHFA program, you guys, you have to be 3-year income tax not owning a home. So back, a lot of people, they say first-time buyer. Okay. The word first-time buyer, I guess it's just a sentence we all say, but the requirement is 3 years of income tax without showing an ownership of a home. So for example, right now, in order for you to qualify for the CALHFA, you need 2017, 2018, and 2019 income tax to show you have not rolled off an interest of a home. So if your parent don't do income tax and they give you their mortgage to help you out so you can get a tax return, it's a beautiful gesture, but then it disqualifies you from being a first-time buyer, on the CALHFA. So that's one of the things. Now, if you do, you guys co-sign for someone on a home, as long as we can get 12 months cancel checks from them, as they are the responsible party and you have not wrote it off on your taxes, yes, you can qualify as a CALHFA with no issue whatsoever. So is that answer everything? I think so, right, Chris? Did I?
Yeah, I think we've covered the big topics unless anybody else has any questions. Where can they find Tom to set an appointment?
Say it again.
To set an appointment, how can people set so you can talk to people one-on-one?
Okay. So the way I've been doing it, and it's been amazing, and I'm so grateful for all my clients. They are willing to do Zoom call or FaceTime with me, and I appreciate it. So that's how we've been doing. So if you guys have any question, any particular, scenario, just please reach out and we can set up a Zoom call and go over, whatever the question you have. And I can send you homework and we can actually get started. The one thing, you guys, I really, really wanted you to look at this process is it's not something you are buying a home tomorrow, okay? Is I wanted you to look at this as this is a first step in the right direction. What would it take to buy a home? Can I qualify? If I can, how much? What is my payment going to be? If I cannot qualify, what would it take to qualify? If I need to work on my credit, how can I clean my credit? So, so I really wanted you to take this time to just go through what would it take. So if you do qualify, and the payment is something is like, ooh, I don't know how to do that. So the question really is, can I look into, we go over a budget, what we need to do a budget, okay? If we decided, you know what, yes, I do qualify, but you know what, I don't feel like I want to buy a home. No problem. When you look at this 6 months from now, a year from now, there is absolutely no regret. You did everything you can, and it wasn't the right time, So I am one of the people, living with regret is not a good thing, you guys. And especially when you get old like me, 57-year-old, and you wanna look back and say, I wish I could have, would have. Not a good thing. So, so that's how I would do. It doesn't cost you anything to go through the steps and find out what would it take, how much score you need to have, how you clean your credit, what you can qualify for. So that's honestly what I would do. Is that?
Nahid, I also have a question.
Sure.
How do student loans affect you in the home buying process?
Great question, Giselle. So with the student loan is, there is two ways with the student loan. Even though if we have them deferred, is still the lender is going to count them as a bill against you, and it's the bill of the monthly payment bill, not the total what you owe on it, okay? So what we had, and I asked my client to do, is they go to the website of the student loan and see what is the max years you can stretch the payment on. And I had some of my clients said they were able to do it for like 20 years. So even though the credit report will show you have to make a $200 payment, but when they went on that website, that $200 payment went down to $50. So the lender asked for you to print that, and that's what we give to the lender. And now the lender uses $50 as a debt instead of the $200. Does that make sense?
Yes, thank you so much for answering my question.
You're welcome. So it's, excuse me, it's not the total what you owe, it's just the monthly payment, the one you have. Any other question, you guys?
Do car leases affect?
Oh yes. Whew. Whew. Okay, so car lease is the same as a car payment, even though it's on a lease. Now, who's the one asked that? Is that you, Jason? Or
Yes.
Okay, Jason. Okay, so I'm gonna share that with you. So I had an amazing client. We had I think it was like 730 FICO score. And he had a beautiful car and the payment was $800 a month. And we qualify him, beautiful. We went shopping, okay? And in the middle of the shopping, before we went to escrow, what he did, he went and he changed the car to another car, okay? And the payment, believe it or not, it was less. When instead of 800, it was 750, okay? So payment was less. So he thought that was okay because it's actually helping because the payment is less. Well, guess what? The FICO score dropped. I think it was like 50 points. And the reason it dropped because the old car he had, the lease was, I think, a year and a half old. The new car was a 30-day brand new loan. So even though the payment was lower, but the new loan, and remember, the old loan got paid off, so it's off the credit, but because it's a brand new loan, the FICO score hit like a drum, and we had to wait a year.
Got it.
Get the score back up. So if you are on a lease, if you can change it to a lower lease and you do it way before we can buy the house so it doesn't have a big old loan as a brand new loan on it,
Right.
then yes.
I'm sorry to cut you off.
Go ahead.
How long would you have to wait?
From the time,
Like what would be the best time frame for you to wait, like before buying a house or before, what am I trying to say? I guess I'm trying to say before switching your loan or your lease to a lower lease and then trying to buy a house. What is the gap in between that you should?
What he's asking is how long would it take? Like if I go buy a new car tomorrow, do you think in 2 months my score will bounce back?
Yeah.
If I bought the car 6 months ago, am I probably in a good position to try?
If you bought the car 6 months ago, then you're good to go.
Okay.
But if you bought the car a couple of months ago, it's going to be high. It's going to hit your FICO score. And you got to remember, with car dealers, you guys, they really don't care about, you know, that's why you can go buy a car and you can walk off the lot with a car. But when you go buy a house, is a totally different story. So, so I would say, if you can, you know, if turning in the lease is something, you could do, that would be awesome. That way we have less payment, but of course not as a negative. You're turning it in and you owe a balance or anything like that.
Got it.
Yeah.
Or always run the credit and see what it is exactly to get the roadmap.
Correct.
Nahid,
Yes.
question. So does that apply? Is that the same rule for when you purchase a car, like when you buy the car?
Yes, the same thing, because you owe the money. See, the whole thing, Alfredo, where the FICO score work, you guys, that way you understand. So the way the algorithm work is, you bought a car for $40,000, okay? Your balance is $40,000 because it's a brand new car. You just made one payment, okay? Now, you bought a car for $40,000. A year later, you don't owe 40, you owe 25. Now you understand why when you buy a car for 40 and you went to the dealer and your credit was 700 and the next day your credit score dropped once the dealer report the car. Does that make sense?
Yes, absolutely.
So it's just what you owe versus what your limits are. So the closer what you owe to your limit, the lower your FICO score will drop.
Yeah.
Okay. So the further away it is, the higher your score. And it just takes time. The same way if you had a late payment, if you had a 30-day late, but it was a year ago, when it hit you like a drum, but it got old by a year later, then your score go up by itself. You didn't have to do nothing to it, but the score went up by itself.
Okay.
So that's
All right,
basically
thanks.
how it works. And like I said, you guys, as far as the credit, I can run the credit. I don't, there's no charge for it. And then from there, we can figure out what we need to do, what steps we have to do, if we need to clean credit, if we don't, if we qualify, or if we don't qualify. All right. So any other question, you guys? Awesome. So I want to say thank you so much for taking out of your busy day and dinner time and all of that to be with us tonight. And please reach out with any questions, any concern, and we would love to be in your journey. That's for sure.
Yeah, thank you,
you so
Nahid.
much.
Thanks for all the information. And I'm sorry I couldn't get connected with you earlier, but
Oh, no.
we're going to set it up.
It's all good, man. It's all good. That's all, it's all good. I'm blessed to have all of you guys, and I appreciate it. And just to kind of give you an idea, Alfredo, and I hope Giselle and Jason, you guys don't mind. Giselle, I sold the house to her mom and dad 20 years ago. So Giselle was a young one, and Jason is Giselle's boyfriend. So it's nice. And Daisy, Daisy, I sold to everybody in the family. So I sold to all her brothers, all her sisters. So most of my business, Alfredo, because you're the new one on the block here, most of my business is past line referrals, and I'm blessed to. And I was telling Jason earlier before you got on, it's really an honor and it's privilege to be able to sell to my client children. So I'm really blessed, and I'm so grateful. They're young and they still accept me as okay, she's old but she knows what she's doing. She can,
That's what matters.
she can get me into something. So it's really an honor, and I appreciate that.
Okay.
Thank you so much.
All right, you guys have a beautiful rest of your day. Thank you so much.
Thank you.
You too. Thank you.
You guys have a good night.
Same.
Thank you.